You have probably heard the ultimate financial survival fantasy. The dollar collapses, hyperinflation kicks in, and suddenly, that terrifying $500,000 mortgage on your house costs the exact same as a loaf of bread. You walk into your bank, hand them a single hyperinflated banknote, and just like that, you own your home free and clear. You outsmarted the system. You won. It sounds mathematically perfect, doesn't it? But there is a massive, fatal flaw in this logic. And it has bankrupted millions of people throughout history who thought they were playing a winning hand. Today, we are going to tear apart the greatest myth in personal finance. We are looking at the brutal, documented historical autopsies of what actually happens to your mortgage, your credit cards, and your personal loans when a fiat currency dies. Because the banks, they do not just roll over and let you take their assets for pennies. They have a playbook. And if you do not understand the rules they are about to rewrite, the debt you think will save you is exactly what they will use to confiscate everything you own. Let us start by understanding why the inflate away your debt theory makes so much sense on paper. The logic is straightforward. If you borrow money at a fixed interest rate and the currency rapidly loses its purchasing power, the real value of what you owe drops. If your monthly mortgage payment is $2,000, and suddenly minimum wage is $2 million an hour because of hyperinflation, that mortgage payment becomes a microscopic fraction of your income. The debt evaporates in real terms. You get to keep the hard asset, the house, while paying the bank back in worthless paper. This is the exact reason why highly leveraged real estate investors preach that debt is a hedge against inflation. And during periods of normal moderate inflation, say 3 to 8%, they are absolutely right. The math works, but moderate inflation is a completely different biological organism than a currency collapse. When a monetary system breaks down, the normal laws of mathematics are suspended and the laws of political survival take over. To see exactly how this trap springs shut, we do not need to guess. We just need to look at Weimar Germany in 1923. As the German mark began its death spiral, savvy German citizens and investors did exactly what the financial gurus tell you to do today. They borrowed heavily. They took out massive mortgages to buy real estate, farms, and factories, assuming the hyperinflation would wipe out their debt. And for a brief, glorious moment, it worked. By late 1923, a wheelbarrow full of German marks could not buy a cup of coffee, but it could theoretically pay off a 30-year mortgage taken out just a few years prior. The borrowers celebrated. They thought they had beaten the banking cartel. But here is the detail that gets left out of every internet forum and financial blog. The banks did not just sit there and accept worthless paper. They went to the government. They argued that allowing citizens to pay off massive debts with suddenly worthless currency would collapse the entire financial system, destroy the banking sector, and completely destabilize the nation. And the government, which relies on the banking system to function and issue its own debt, agreed. They passed emergency legislation. They introduced something called the Mortgage Revaluation Clause. Overnight, the rules of the game were changed retrospectively. The government decreed that all existing mortgages and long-term debts would not be settled in the hyperinflated paper marks. Instead, they were legally repegged to the new stable currency backed by gold and land, known as the Rentenmark. The debts were revalued at a percentage of their original gold-backed purchasing power. So, if you thought you owed the price of a loaf of bread, you woke up the next morning to find that the government had legally reinstated your massive debt burden in a brand new currency that you did not possess. But it gets worse, because during the hyperinflationary period, the economy had ground to a halt. Businesses failed. Wages, in real terms, plummeted. So when these citizens had their mortgages revalued into the new hard currency, they had no income to service the debt. The result? Mass foreclosures. The banks, backed by emergency government decrees, swept in and confiscated the properties. The people who thought debt was their ultimate inflation shield ended up homeless. This is the ultimate lesson of a currency collapse. The entity that writes the contract and the entity that enforces the law will always collude to protect themselves before they protect you. Now, you might be thinking, that was 100 years ago in Europe. That cannot happen here. Our contracts are ironclad. If you believe that, you have not read the fine print of your own loan documents, and you certainly have not paid attention to modern history. Let us pivot from fixed-rate mortgages to the most toxic financial instrument in a crisis: short-term and variable rate debt. Credit cards. Home equity lines of credit. Adjustable rate mortgages. If a currency begins to fail, holding this type of debt is the equivalent of swallowing financial poison. When inflation spikes, a central bank only has one primary weapon to fight it: raising interest rates. We saw this in the 1980s in the United States when Paul Volcker pushed the federal funds rate to nearly 20%. But in a true currency crisis, 20% is nothing. In Argentina, during their recurring currency crises, credit card interest rates have routinely spiked above 100, 200, even 300% annually. In Zimbabwe, interest rates on short-term lending reached astronomical, unpayable levels. If you have a credit card balance or an adjustable rate mortgage when a currency collapses, your interest rate is not going to stay at 18% or 7%. The bank will adjust the rate to outpace inflation. If inflation hits 50% a month, your credit card interest rate will be adjusted to 60% a month. Your balance will compound so violently that within 90 days, a $5,000 credit card bill could require your entire annual salary just to cover the minimum interest payment. And if you default, the banks aggressively pursue judgments, garnishing whatever wages you have, or placing liens on your physical assets. But what about the fixed-rate U.S. mortgage? A 30-year fixed mortgage is considered the holy grail of inflation protection because the bank cannot legally change the interest rate. It is locked in. This is true, but the bank does not need to change the interest rate to destroy you during a collapse. They just need to wait for the economic fallout. During a severe currency devaluation, the broader economy crashes, supply chains freeze, companies go bankrupt, unemployment skyrockets. So, while your mortgage payment remains fixed at $2,000, what happens if you lose your job? What happens if your company cannot afford to pay you because they cannot import raw materials? Or what if you keep your job, but your salary does not increase as fast as the cost of food and energy? This is the hidden trap of the 30-year fixed mortgage during hyperinflation. Yes, the debt becomes nominally cheaper, but your ability to generate the cash to pay, it often drops even faster. If a loaf of bread costs $50 and a gallon of gas costs $80, all of your available cash goes toward basic biological survival. You miss one mortgage payment, then two. It does not matter that the mortgage is mathematically cheaper relative to the economy. If you do not have the liquidity to service the debt, the bank forecloses. Furthermore, we must address the force majeure and emergency regulatory powers. In the event of a systemic banking collapse, governments can and will authorize bank holidays. They freeze accounts. In extreme scenarios such as the bail-ins seen in Cyprus in 2013, unsecured deposits in the bank were simply confiscated and converted into worthless bank equity to save the institution. If the banking system faces an existential threat from hyperinflation, do not put it past regulators to implement modern versions of the mortgage revaluation clause. They could index existing loan balances to inflation metrics, citing national economic emergency. When the system is dying, the sanctity of a consumer loan contract is the first thing thrown out the window. So, where does this leave you? Is all debt a death sentence in a collapse? Not exactly. The key to surviving a currency reset is not avoiding debt entirely, but restructuring it strategically before the collapse happens, and understanding the difference between toxic liabilities and productive leverage. The only debt that genuinely protects you in a systemic crisis is fixed-rate debt used to purchase income-producing, hard assets, provided you have a secondary crisis-proof way to service that debt. Let me break that down. If you have a fixed-rate mortgage on a rental property and the currency collapses, the property retains its fundamental value because it provides a basic human need: shelter. As inflation rages, you can raise the rent to match the new inflationary environment. Your tenant pays you in the hyperinflated currency, and you take that currency and hand it straight to the bank to pay your fixed-rate mortgage. The asset itself is generating the inflation-adjusted cash flow required to service the debt. You are using the bank's money to hold a real asset, and you are using the tenant's inflation-adjusted income to pay the bank. This is how generational wealth is preserved during monetary resets. But if that fixed-rate mortgage is on your primary residence, you do not have a tenant. You are the tenant. If your personal income does not keep pace with inflation, you cannot service the debt. This brings us to the ultimate survival strategy for debt. Step 1. Mercilessly eliminate all variable rate debt. Credit cards, personal loans, adjustable rate mortgages. These are financial suicide in an inflationary spiral. Step 2. If you hold fixed-rate debt on assets like your home, you must build a parallel liquidity reserve. You need access to capital that is not tied to the collapsing domestic currency. This means holding physical precious metals, foreign hard currencies, or extremely liquid, globally recognized assets. When your domestic income fails to cover your fixed mortgage due to the economic chaos, you liquidate a tiny fraction of your gold or foreign currency, which has skyrocketed in value against your local currency, to easily make your mortgage payments and keep the bank away from your door. You do not beat the bank by hoping they accept worthless paper. You beat the bank by holding assets that cannot be printed and using them to effortlessly service the fixed legal contracts the bank is bound by. The rules of money are changing rapidly. The national debt is compounding. The printing presses are warm, and the historical precedents are screaming at us. Hyperinflation and currency collapse are not events where the little guy magically wins by defaulting on loans. They are events where wealth is violently transferred from the uninformed to the prepared. The banks have their emergency clauses, their political lobbyists, and their historical playbooks ready. The question is, what is your playbook? If you want to understand the forensic reality of how the financial system actually works and how to position yourself before the next major economic shift, hit the subscribe button right now. We do not do financial fantasy here. We do historical facts and survival mathematics. Scroll down to the comments and let me know, what percentage of your current debt is fixed rate versus variable rate? Are you positioned to survive a massive interest rate shock? Drop your thoughts below, and I will see you in the next analysis.